If you're just starting out, getting into the financial world, looking at stock markets, there is just so much jargon, words that you've never seen before. And I remember when I started broking, the first couple of months was literally just me reading up on all of these terms, trying not to sound really stupid. So here are the most common terms that you hear in stockbroking and in the markets in general. Liquidity. This is essentially just referring to how easy it is to buy and sell a stock, or how much volume you can actually trade in the stock. So for example, Apple, Amazon, Google, all of those big names, they are incredibly liquid stocks, meaning that the shares change hands very often. It's very easy to go and buy a lot of the stock or sell it. The market is very active. If the company is not very liquid, it is actually difficult to find buyers and sellers in the stock. You may want to sell, but there's no one there to buy it. So liquidity is important. Liquid stocks are good. Illiquid stocks, sometimes difficult to actually trade. Bid ask, or in the UK, this is known as the bid offer. And this is essentially the market in a stock. When you want to buy or sell a stock, then you have to go and look at the price. But there isn't just one price, because there are buyers and sellers, and the price is different. So if you want to buy a stock, you have to pay the ask or pay the offer. Whatever anyone is willing to offer you their stock for, you have to pay that. If you're selling a stock, then you have to sell at the bid. People are bidding for your stock, and you have to go and sell it at that. So bid is when you want to sell. If you want to buy it, you have to pay the offer. Go long, this just simply means taking a position in something. So related to stocks, if you go long a stock, you are buying that stock, and you expect it therefore to go up in price. You are betting positively on that stock. You want to buy it, you want to hold it, you want the price to rise. Go short is simply the opposite, and well, more specifically, if you are short a stock, it means that you don't actually have any stock to sell, but you are selling stock that you don't have. That is possible in the markets, especially with stocks and equities. You can trade maybe a week without having to settle the trade. So you can go short, you can sell stock that you don't have. And really, you're hoping and betting that within that 10 days, for example, the price falls quite significantly and you can buy the stock back to settle your short trade. So when you go short, you want the price to go down. Averaging down is a term where investors have bought a stock and the price falls, and they really don't think that long term the price is going to keep falling. So what they want to do is buy more stock at that lower level so that their average price is reduced. You are averaging down, so you buy at 100, you buy at 80, you buy at 70, and your average price will come down. Limit order. This is an order you place with your broker at a specific price. So if the stock is trading at 101, your limit order is at 100. It will not be executed. If the price falls, then your order will go through. You have a limit on how much you want to pay for the stock. Market order is just the opposite. You tell your broker, I want to buy 1,000 shares, just go and buy them. I don't care about the price. Whatever the market price is, that's what I'll pay. GTC, good till cancelled. This is a time limit. So you ring up your broker and say, I want to buy 1,000 shares of this stock at $100. This order is good until I physically ring in again and say, I don't want the order to stand. So it will just keep on in the system until you cancel it. Volume is simply a metric of how many shares have traded that day. Could be 100,000, 200,000 shares. Volume is important for brokers and traders to see the activity in a stock. If the volume is very low, that's not usually very good. If the price is rising on heavy volume, on heavy trading, it's usually a good sign that there may be a breakout. Bull market is a positive market, a market where prices are rising. And maybe the economy is good, or just generally the market is seeming quite good for the future, maybe 5 years, and prices are rising, keep going up, bull market. Bear market is the complete opposite. A recession is coming, stocks are falling time and time again over a long period, a bear market. Market cap or market capitalization is simply how valuable a company is based on its share price. You just take the share price, times it by how many shares there are, and you get the market cap. It's just a broad view, and you can compare market caps and see how big one company is compared to another. IPO, initial public offering, is when a private company that has shares that are privately held goes onto a stock market and is available for anyone to trade. That one change is the initial public offering of their stock. Fundamentals refers to the fundamental revenue income of a company. So a company's share price may not bear too much relation to its fundamentals. Value investors usually look at company fundamentals. They want to see very good revenue or profit growth over time. Fundamentals refers to the company's business rather than anything to do with the share price. Dividends are paid by companies to reward investors for their investment. So some companies do pay dividends, some companies don't and reinvest that money into their growth. But a dividend is something you receive as an investor from a company that pays you a part of the profits, maybe once or twice a year. Hedge funds are really groups of people, either within banks or separately, that take money from rich people and try and get them a return over and above what they can get in the market. There are many ways of doing this. They may trade very complex instruments. They may be aggressive and try and buy out companies because they see that they're undervalued. Lots of different ways to make money, but they try and outperform the market for rich people that give them money. Mutual funds are for us normal oi polloi people, and we can just put $50 a month or whatever into these funds. They group a massive range of investments into one vehicle so that we can invest in something that is fairly low risk and diversified. ETFs or exchange traded funds are the same thing as mutual funds really, and of course they are traded on an exchange really just to make it easy to invest in. They can track anything. They may be a group of investments. They may track an index, many different types, but they are traded on an exchange for us to purchase. ADRs, American Depository Receipts, are certificates issued by certain banks that enable American investors to buy or take bets on companies that aren't listed in the States. So a lot of American investors want to invest in some UK stocks that aren't listed in the States. They can't really do that because there are rules, but they can buy ADRs. Day trading is when you will trade different instruments, maybe stocks and shares, CFDs, options, Forex, gold, oil, anything. You are trading on a daily basis, trying to make money every day by making short-term trades. The other name for this is gambling because it just is. CFDs are contracts for difference. They are a derivative. So you can have a CFD on, for example, Apple stock. And rather than buying Apple stock, you may want to trade a CFD with Apple stock. And the price movements in the CFD are essentially a bet on the price. So why not just buy Apple stock? Well, with CFDs, you can leverage. So you can actually put forth quite a small amount as margin, and you can trade a much bigger position than you actually currently have. So because of that, they are very risky and not really recommended for most people. But the reason why people trade them is because they can get a lot of margin, and also in the UK anyway, they are tax-free, and some people like that. Options simply give you the right to either buy or sell something at a given price. So it's a contract between you and somebody else, almost like a bet, where you have the option, for example, to sell Apple stock at some price in the future. And why would you do this? Well, if you have a big position in Apple and you like Apple and you think that long term it's a very good stock, you don't really want to trade it. But short term, there may be a recession and the price is falling and you think short term the price is going to fall. You can trade options on Apple stock and it may just give you some insurance in your position. That's just one way of doing it. There's a lot of different reasons why people trade options, but they are essentially a contract between you and someone else that enables you to buy or sell something at a given price in the future. And it can be a derivative of Apple stock or a lot of different things as well. Margin is something that is commonly placed with the bank when you trade derivatives. So if you are trading Apple options, you don't have to fund the entire trade at once. You can pay small premiums. It's basically like insurance, but you need an amount of margin to trade. So margin is the amount that you need in your account to fund that trade, but the trade is actually much larger than that. You don't need that, you just need the margin. A rally is where stock prices usually have been falling quite heavily, but then that price movement turns around and they start making ground, going up, going into positive territory. That is a stock market rally, when the prices fall and then they do rally and go back up. Take a bath is when you buy a stock and it just goes south. You just have a terrible loss in the stock. You buy a stock at 100, it just tumbles down, goes bankrupt, just terrible. You have taken a big bath and lost your money. Shame to end the video on that one, losing all of our money and taking a bath, but that's the way it is in the stock market a lot of the time. Anyway, I hope you enjoyed that one. Send me a comment, hit the like button and subscribe. Thank you for watching. That's it for this time, and I'll see you in the next one.